Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There is a mega deal in the mining industry today. The UK's Anglo American has agreed to buy Canada's Teck resources. This is going to create a more than $50 billion company, and it is one of the biggest mining deals we've seen in about 10 years. And here to break it down for us is Richard Bourke, Bloomberg Intelligence Senior Analyst, Basic Materials. You've got a busy day here, Richard. Thanks so much for coming in. We appreciate it. The company is presenting this as a zero premium transaction. Just tell us what that is.
Okay, so what they've done is it's a merger of equals, and it's kind of interesting, even though it's labeled a merger of equal, that American Anglo shareholders are going to end up owning about 2/3 of the company, roughly, and Teck shareholders going to end up owning 1/3 of the company. But it's going to be headquartered in Canada. The board is going to be 50-50, and the management's going to be 50-50. So even though it's kind of, nil premium merger equals, kind of, the governance issues kind of point to a merger equals, and that's really probably structured in order to get approval by the Investment Act, Canada Investment Act, and also the Cavill family that owns. Teck has two classes of shareholders, Class A and Class B. Class A is super voting rights. He owns a majority of those shares, so he has to approve this deal. In the past, Glencore, when Glencore tried to buy them about 2 years ago, he kind of vetoed the deal, so the deal didn't go through. So there's kind of a unique structure to this deal to kind of, fit it through final approval.
Makes sense.
Okay, so there was also language in the statement of this so-called merger of equals that would allow both firms to consider unsolicited proposals and for the deal to end if there's a better offer. Does that mean they're angling for some counteroffer from someone else?
Well, I think it would be a hard press. I doubt, in order to get it through the Canadian Investment Act, which copper is now being considered a critical mineral. Canada has said they don't want to see any of their mining companies go away. So would somebody come in who can pay that much, be willing, or a BHP or Rio Tinto, be willing to move their headquarters from where they're at to Canada? I highly doubt it. But I think you have to put that language in the deal that, hey, we're open to.
So it's like boilerplate language more than anything
boilerplate, and
else.
also prevent that you don't get sued by shareholders that you haven't gone out and looked at for all deals.
Right. Do you think that this deal, though, between Anglo American and Teck is going to be the thing that sort of ignites more M&A in this industry? I
think, there used to be an old saying, I used to cover the oil and gas industry years ago before I more focused on metals and mining. There used to be an old saying, it's cheaper to drill on Wall Street than drill out there in the field. And that seems to be happening if you look at how much it costs to, get a new copper deposit up and running, also how many years with permitting and all the other things that happens, you can see that maybe you sit down and look at this and say, okay, it may be cheaper to mine on Wall Street than to go out and make a mine.
Okay, before this deal was announced, we've seen that both companies have tried to simplify their businesses. Teck sold the majority of its coal business to Glencore. Anglo American exited the platinum business and is trying to sell its coal mines and wants to get rid of its De Beers diamond unit. Is that going to continue that effort, and will it be harder or easier to do that as part of this giant company?
Well, they're both going to, Anglo is going to continue to try to sell coal business and sell De Beers. They think they're going to get it done before the deal closes. The deal's supposed to close 12 to 18 months, they said. Those are, and Teck was, 2-3 years ago, there was a big push for green companies. Coal is viewed as very dirty and things like that. So
not anymore.
We've seen companies try to get out of that business to kind of appease shareholders, especially over in Europe. It's a bigger push much than in the U.S. So I still see those actions continuing.
It's being billed as a merger of equals, but I'm wondering if one party here is getting a better deal than the other. Because if you look at Anglo American, if this happens for them, they're going to get that high quality copper asset, right, which is really coveted in the industry. Would you agree that Anglo American sort of has a better end of the bargain here?
Well, the question is, Teck has had problems bringing a new mine on Quebrada online. And the question is somebody, one of the investors I was talking this morning goes, well, yes, if QB gets fixed and everything runs, it looks like a great deal for Anglo, but are you buying a fixer-upper or not? And Teck, honestly, they've been very good operators in the coal business. They've got exit the coal business. They haven't been as good operators in the copper business. So to bring in some expertise, Anglo has a little more expertise in the copper business. It may help them, realize the value there.
Richard, you mentioned that Canada needs to approve this deal. I believe the regulators in China and the U.S. need to as well. Which countries are going to be hardest to get approval from?
Well, I think it all depends. A year ago, I would have said Canada. But given that China probably considers copper a critical mineral now, that may, and given how the geopolitics that are going on in the world, it may be, there's going to be everybody taking a kind of a very measured look at this deal before it gets approved.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's go back to the Dell story. I look at the shares, and the shares are on a downtrend right now, at least for this morning, down 2.5% for at $119. Woo Jin Ho, we've been promising that he'd come over and make us smarter on this. Woo Jin Ho is Senior Technology Analyst at Bloomberg Intelligence. The CFO, Yvonne McGill, stepping down after 2 years in the role. What does the share price drop reflect exactly, Woo Jin? Is it fear that a key member of the management team is leaving and others might follow her? What do you think is going on?
Yeah, hey, Scarlet. So I think it's more along the lines of the timing of her departure. Keep in mind that these guys reported 2 weeks ago. That could have been a time where she could have announced her resignation. And the analyst day is about a month away. That's another time. She could have set the numbers straight there and then resigned there. So it's just more of a timing aspect of it than anything else. I think what brings a little bit of confidence to the shares is that the company reaffirmed the third quarter guidance as well as a full year guidance for all intent and purposes. And that's backed by the COO, Jeff Clark, and the CEO, Michael Dell.
Woo Jin, why did McGill leave? Do we know? Why did she resign?
No one knows. On the analyst callback last night, the example, the reasoning was more along the lines of she's been at Dell for over 30 years, and she went through she took Dell through multiple transitions, and it seemed like a case of burnout. I mean, it's really tough to say what the personal reasonings may be, but we don't think there's another job that she may be going after, given that she is going to be sticking around for an interim period. But it may have been more for personal reasons than anything else.
Okay, so it may have been more for personal reasons than anything else. Tell us a little bit more about Dell's prospects right now. You mentioned that they reaffirmed their guidance, so that should be something somewhat soothing to investors. And they had just reported earnings where they beat earnings estimates, yet the stock was down nonetheless. Does that mean that perhaps there's a little bit of rebalancing here in terms of expectations for what Dell can achieve going forward?
Yeah, so let's address both. Let me address the CFO search first. As I noted in my comments yesterday, my written comments yesterday, look, they have a deep bench, right? And the person coming in to take the interim role, I think David Kennedy, he's the CFO of their Consumer Solutions Group, which pretty much handles the PC group. He's going to easily slide right in, as well as Jeff Clark being a steady hand on the COO role. He knows the finances of the company well. Are they going to look internally or externally? I don't know. I mean, I wouldn't be surprised if they just appoint Mr. Kennedy as the CFO, ultimately. But we'll see. We'll see what happens. Now, you actually bring a pretty good question, right? The company is evolving. If we think about the company's business model, AI just came out of nowhere. Right after Yvonne took the CFO role. And that business is going to be as large as a traditional services server business in about a year or so. And however, that comes with lower margin. So there is going to be a margin aspect of the business that the new CFO will need to manage going forward. On top of that, a pretty, stable but competitive PC market going forward.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Want to move over now and talk about our big take on Bloomberg today. It's a good one. Puts forth this idea that the Trump administration is going to war with established climate science. When you consider mass firings, regulatory rollbacks, there have been funding cuts ongoing, program closures, et cetera, et cetera. Eric Roston, Bloomberg Climate Reporter, one of the authors of this report on the Bloomberg Terminal. And Eric, thanks so much for joining us here in the studio. Just sort of break down for us all of these changes happening. How do they actually impact the U.S.'s ability to gather data in this area?
Yeah, I'll start with that last part, right? Whether you are a mayor of a city or head of an insurance company or head of an agriculture company, everyone throughout the economy, public or private sector, needs good information to make good decisions. And the U.S. in recent decades has had the global leadership role in developing the kinds of data that everybody needs in order to see what's coming, to set insurance rates, to understand whether we should build a house here, to understand if this floodplain is going to be like a bad place to build houses. And so that's the data we're talking about here, is actionable data that people in the economy have come to rely on to make decisions. To cite one of the many examples we talk about in the story, the U.S. produces, it's supposed to be not more than every 4 years, a national climate assessment, which is a huge
amount of time, right?
A huge amount of time. It take years to develop, hundreds of people to write, and thousands of papers that they're based on. And you see these reports cited in Travelers' earning calls and Chipotle earning calls and reports, and Marriott. Brands we see every day understand the material and understand the needs of this material. I'm not putting words in their mouth. I'm just pointing out that they say things like this. Those were taken away from public view. So I think that's an interesting place to start on, because, the government, any government, can be cut, right, and save money. And it's just the nature of bureaucracy. But why are some of the most authoritative and well-vetted scientific reports ever written being taken away from public view, where they've been for many years?
All good questions, and I'm sure that we won't get answers to them right away either. So what does it mean if you're a company like Travelers and you're relying on that data? Can you go to private sources for that kind of information? Does that exist?
That's a great question. And if we had another 2 hours, I'd love to, because we've spent a lot of time in the last few years on the private sector's, filling a hole in useful climate data that businesses need. So the short answer is yes. Some of this data, a lot of it is translated into the language of risk for companies. It does exist. The bigger concern is that's a tiny fraction of what we're talking about here. Mm-hmm. We're talking about very sophisticated computer models that like the entire world relies on to make sense of, observations we see in weather stations and in other sources. In a particularly, I don't know, I'll get in trouble for saying this, but this could be described as like the most boring kind of data is also some of the most important. And that is...
it's unsexy data.
Unsexy data is like continuous monitoring data. It's very important for some kinds of data that you have a complete unbroken record. The most iconic one in this space is the CO2 measurements from Hawaii on Mauna Loa that have been going on since the late 1950s and are largely responsible for the discovery of global warming. Like that data set, one of the most famous data sets ever collected, was slated for closure in the recent White House budget.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
But I want to talk now about the Fed, because that's what we keep doing here as we lead up to next week's meeting. And Wall Street's betting on the Fed handing us our first interest rate cut of the year. How large of a cut is still up for debate, but what's it going to mean for banks, especially those regional banks? Well, who better to talk about it than John Buran? He's CEO of Flushing Financial, and he joins us here now in our studios. John, good to see you.
Great to be here.
I'm just curious because I know that smaller banks can usually be more nimble when there's policy change. What are you looking for from the Fed next week? And how are you positioning your bank to take advantage of whatever it is they do?
Well, we're in a great position if the Fed cuts rates. Our funding costs go down and demand starts to pick up. So we've been dealing with, for about 2 years, with pretty much a inverted yield curve, and that is not the best place for banks to be. So banks tend to, particularly community banks, tend to borrow a little bit on the short side and lend a little bit more on the long side of the yield curve. So having a more positively sloped yield curve would be very, very helpful. So if the Fed reduces rates, that reduces the shorter end of the yield curve. So we're hopeful to see more than one, but we've got high expectations for the one in September for sure. Positive impact for us.
As Alexis mentioned, this will be the first rate cut of the year. So there's been a lot of anticipation that borrowing costs will come down. What kind of preparations have your customers, your clients made for this rate cut? I mean, are they ready to go when that rate cut comes through?
Oh, I think they've been ready for a while. They've been holding back on investments, clearly. So we've seen over the course of these past couple of years, really very, very low rate of investment, a very, very low rate of companies building more plant, going into longer term investments. The commercial real estate market is very, very, very slow at this point in time. So we have an expectation that if those rates start to come down, that will generate a significant amount of business.
A lot of your business does come from the small business and commercial side, right, versus individual or residential. But I'm wondering if those two markets are sort of in lockstep with each other. Have they been?
Oh, they clearly are. I think I think a reduction in rates will help housing costs as well, and possibly spark another round of refinance activity, which is always very important in the real estate market.
You're very much exposed to multifamily housing, lending to companies that are invested in that space. What can you tell us about where things stand right now? Because there's an affordability crisis, not just in New York, but across the nation. And I'm wondering how that plays out on your customers and what that means for their demand for loans.
So the multifamily market has been pretty calm over the past couple of years between the rate environment and also the situation with respect to concerns about multifamily in general. So where we're at right now is that the market is such that a reduction in rates will clearly spark some refi activity, clearly spark some more investment in the market. Now we're dealing also with concerns about the environment with respect to the mayoral election, possible freeze on rates.
Yep.
But when you look at it from a banking perspective, most of the difficulties in this market have been non-banks. And banks that have done well in terms of their stress testing their loans initially, watching their capitalization rates, are really, really in good shape. We have not seen that predicted disaster that was going to take place in commercial real estate. And reduction in rates will just help to move us in a positive direction.
What is the regulatory landscape like for the regional banks right now? Has it been a friendly one for you over the past few months?
It clearly is showing signs of improving. For example, M&A activity is moving along very, very quickly, much more quickly than under the prior administration. Clearly there's been a lot of discussion about even increasing the cap on FDIC coverage is certainly out there as a discussion item. So we're starting to see a much more business-friendly environment. Not all of it is in place yet, but those pieces, when they come together, and particularly when the interest rate piece comes together, if we see more than one, and we're here in December with 3 interest rate cuts, I think that's a real impetus for major economic activity.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.